I don't know.
Hello, everyone. Perry leading with an I don't know. I love it. Hi, y'all. My name is Jessie Lang, and this is our Tuesday live stream. We have an amazing guest on with us today, Perry, who I will let him introduce himself. But I just want to give a quick little intro. If you guys don't know me, like I said, my name is Jessie Lang. I teach people to buy 1 to 3 rentals per month on autopilot, even if you don't have any real estate yet. It is still something that is totally achievable. We aim to get you that first rental in your first 90 days. So that is what I do. I have a large portfolio here in Columbus, and I actually met Perry through a coaching program for coaches, which is awesome. And he happens to be in New Albany, right?
Yep.
New Albany. So we were on a nationwide group, and it was like, hey, I'm Columbus, hey, I'm New Albany. So we immediately were attracted together. My group is called Unlocked. His is Cash Flow Unlocked. And we were like, okay, this is a little too weird. So Perry and I have been working on different projects together for the last 2 years now.
Something like that.
Yeah. 2 years. And he is a amazing financial strategist, which implements and incorporates very, very well with buying real estate. So we have a lot in common. Let me turn over to you. Give a quick intro.
Yeah, absolutely. So appreciate the time, Justin. Let's see, intro. Yep, I live here in Columbus, Ohio, originally from Akron, Ohio. Lovely wife, Sarah, who is actually how we got connected. Not how we got connected, but my wife, who I retired from being a massage therapist for 20 years, was looking for what's the next thing to do. And saw what Jessie was doing with her program and said, oh, yeah. So I signed my wife up without telling her.
She found out the day of.
She found out the day of.
What am I doing?
She found out the day of she was in a program. Not the happiest person. Nonetheless, she came through Jessie's program, bought a couple properties. Currently, we're in a contract for a piece of land that we're looking to develop now.
Awesome.
She's just now all in on the real estate side. So big shout out to Jessie and her team and Lizzie over there to everything that you guys do. So what I do, I'm here, headquartered here in Columbus, Ohio, but clients across the country. I'm the president of Diamond Equity Advisors, which is a registered investment advisory firm. So we have all the traditional licenses to be considered a financial advisor, but we don't like the word financial advisor or the term financial advisor. We're more financial strategists, which aligns with what Jessie does, because we're all about helping our clients create wealth through passive income, monthly recurring income, things of that nature. So looking at what we'll call the 4 millionaire mountains, which are real estate, entrepreneurship, infopreneurship, as well as traditional, non-traditional investments. So it was just a perfect fit when Jessie and I linked up, just because my strategies are all about getting people access to capital to go out and buy assets that can give them monthly recurring income to give them financial freedom. So I'm here and I'm a resource to the group. Happy to be here again, my friend. Let's rock and roll.
Yeah. Thank you. And I guess I forgot to mention, Perry's been through my program. I've been through his program, and actually I give you a ton of credit because we now know our financial freedom number, and I'm pretty dang close to hitting it in a method that I did not even think of before. I know. So we're really, really close. And actually, believe it or not, that method it's real estate related, adjacent. It's not exactly.
Ooh, yeah. I like that.
Exactly what you think. So
I like that.
Our topic today, and where kind of our powers combined, is we are teaching you what we call double leverage. We are teaching you how to take a account that you very likely already have access to, and we'll go over a bunch of examples, but 401ks to IRAs to HELOCs, and taking those funds and using it to go out and buy real estate. So we have a really, really cool tool that is custom built just for this community and, for both of our communities. So if you guys want access to this calculator as we go through, you're going to see how powerful it is. Stay to the end and we will let you know how to get access. So I'm going to go ahead and start sharing my screen. Nope. Is this it? There we go. Okay. So here we are. This is our calculator. Contact information is here. So we would love to get in touch with everyone watching YouTube, either Facebook group, Instagram. If you are watching the replay, whatever it is, we want to get in touch with you. So don't hesitate to reach out. I do need to put a disclaimer out there that this is for informational purposes only. It's not intended for financial advice, anything like that. Perry, you probably know the disclaimer much better.
You did great. Absolutely. Yep.
So
this is information purposes only.
Yeah. If you guys want to work with a financial advisor on your own specific situation, I have an amazing one in the room. And then there are tons of really good advisors, but definitely reach out to Perry. And then this calculator, it works on some assumptions. So the first assumption is that the market stays consistent on average year over year over the period that we're analyzing. So we can look at things over a 1 year, a 3 year, 5 year, 10 year, you'll see how it works. But on whatever period you're analyzing, the assumption is that the market stays the same during that period. Okay. We know that's not quite true, but if you're looking at a long enough projection, then averages, things tend to average out. This also assumes that you do not refinance, sell, or buy any more real estate during the time that you're analyzing. So if you're going to buy a bunch and sell it 2 years later and expect 10-year returns, clearly that's not going to happen. So you got to own it for that whole time, right? Okay. So I'm going to turn it over to Perry. You want to talk about some of these account types where people here may have some money sitting. And it looks like there's a lot of y'all on, which is awesome. Really excited to see that. So if you're looking at this, let us know in the comments. You don't say, how much or whatever, but if you have any of these accounts listed here, let us know in the comments and we can do maybe a little bit deeper dive and kind of help you out on some of those. So Perry, take it away.
Yeah, for sure. So just to make sure we level set as well, Jesse's done a great job with it. What we are looking at is, hey, some of us may have one or all of these assets and may not even realize that these assets provide us with access to working capital or lines of credit or loans for us to be able to go out and find real estate. What we have found out on average, anybody that we've worked with, on average, we're finding about $150,000 that they didn't know they had. You can go out and shop for real estate and cash producing assets differently when you have access to capital. So just
can you find $150K for me?
Let's see here. I think so.
You can do it. Awesome.
Yeah, absolutely. So let's go through these real quick. Many of us have 401ks, whether it's a current 401k or old 401k. Most 401ks, well, I'm gonna say that, let me put it this way. 401ks per ERISA guidelines allow you to borrow up to 50% of the value of your 401k up to a max of $50,000. Now, your employer may have chosen to turn that off. So though that's something available with all 401ks, you still need to talk to your employer, the HR, to see if that is the provision that they have.
And so we have that down here. So, holding accounts you may not be able to borrow is 401k that the employer doesn't offer. So
yep. Awesome. So you call in, hey, what's cool about that loan is that you can borrow. There's no taxes. There's no penalties. Oh, guess what? It doesn't report to the credit bureau, so it doesn't affect your debt to income ratio. It is a private loan. And another benefit is when you borrow those dollars, you do have a principal and interest payment. That principal and interest payment goes back into your account. It does not go to a bank. It goes back into your account. So you are truly borrowing from yourself.
Cool.
Yep. Solo 401k, same deal, except for a solo 401k is, hey, I no longer work for an employer. I now work for myself and I establish a 401k for myself. Same guidelines. Cool.
I realized I didn't tee this up very well, but the loan to value is how much of the value in that account can you borrow against?
Yep.
So if you have $100K in the account, in this first example, you would be able to access 50,000.
Correct. Yep. Yeah. It's 50% of the value of the account to a max of 50K.
Cool.
Yep. And the same way with the solo 401k, just the deal is the solo 401k you establish on your own. You have your business, you want to have a retirement account, you establish that on your own, hence solo 401k.
Cool. Yep. What about an IRA?
IRA. So something that not a lot of advisors will speak to. I will, because most of my clients are investing in real estate and other ventures. So with your IRA, let's say you have a traditional or a Roth IRA, you can actually take money out of your IRA and use those dollars to say go fund the deal. But here are kind of the specifications, if you will, that goes along with that. You can implement what's called a 60-day indirect rollover, which means you can take money out of the IRA, and as long as you have those dollars back within 60 days, no taxes, no penalties. We actually just helped a shared client of ours, Jesse, to implement this exact deal. They needed $15,000. We actually had that IRA. We did a distribution for them, didn't withhold any taxes, shot them to 15,000. Less than 60 days, they put it back, no harm, no foul. So really good for a short-term loan.
And zero interest. You're not going to see that really anywhere else here.
Nope, there's no payment on that because you took the money out. Now, little tidbit. Let's say you took out, that 15,000, and the deal didn't go to where you thought it was going to go, and you can't put the entire 15,000 back. You can put in partial. So, man, I took out 15. Let me put back 10. You put back that 10, no taxes and penalties on that 10, and then that 5,000 that you could not put back is just going to be treated as ordinary income. And if you're under 59 and a half, you may have that 10% penalty on it, which, when you think about it, still isn't bad, because a lot of people paying more than 10% for hard money loans, right?
Yeah, totally.
So still, if you think about that penalty not being a penalty but being a cost of funds, still pretty good money.
Okay, yeah, that kind of switched something a little for me. So yeah, I appreciate that. Let's talk about a HELOC on a personal and an investment property.
Yeah, yep. So HELOC, your home equity line of credit. We've used this extensively with our home here that we purchased. So with your HELOC, if you have equity in your home, we're talking about your primary residence right now, you can probably go to your credit union, your bank, and say, hey, I want to apply for a HELOC. That is a home equity line of credit, different from a cash out refi. So this is, hey, my home is worth $1 million. I owe 600,000. That's 400,000 in equity. Hey, bank, how much will you give me in the form of a line of credit based upon that $400,000 in equity, right? And then you have that line of credit, usually very inexpensive to set up, and you only pay interest on what you draw down on it. So there's no ongoing payment or debt service to have a HELOC. Yes. Only when you start to draw down on it and use that. And just make sure you use it wisely, follow some of the direction that Jesse would give you as far as, possibly doing that for a down payment on a property. We've done it multiple times now. We used our HELOC to buy our first 2 properties.
And so it's an incredibly powerful tool. It is something that even if you have, I don't know why you're here if you have no plans to buy real estate, but even if you have no plans to buy real estate, I would still recommend that you have a HELOC for an emergency, in case of emergency. Like if you're sitting on 200K in equity on your personal home. If you bought your home before COVID, I am confident you have at least 100K there. Like I would say at least, unless I could think of maybe a couple of situations, but that is going to be pretty safe. And so, who knows when you may need access to a good sum of money. So, could be to buy real estate, could just be general emergency.
Let me add to that, Jesse. Great point there. When I get asked this question a lot, Perry, I know I have some equity on my home. When should I get a HELOC? Yesterday.
Yeah.
You want to have a HELOC established before you need it. The worst thing you want to do is like, oh, I need it. And it's an emergency. I lost my job. Something happened. I had a break in my income. No, while you can show strong income and get easily approved, just put it in place now. Yes. And when you need it, you need it. So great point from an emergency standpoint, not just buying real estate.
And so if you look on the difference between personal investment, personal is, in the eyes of the bank, is deemed a little bit less risky. So they're going to give you a higher loan to value. They're going to give you a little bit better interest to borrow against. And so an investment, there are quite a few HELOC lenders that will do investment properties. Again, they're not going up to 90%. We see 70, maybe 80. And the HELOC here, there's no growth rate of the original money because it's your home, right?
Mm-hmm.
Yeah.
Yep. Absolutely. Yep. And again, one of our favorite ones. Absolutely. Yep.
Okay, so then we got the S block. What the heck
Ooh.
are all those letters about?
Yeah. So let's go S block, security-based line of credit. So this is where I really made I'm gonna say a name for myself in the early 2000s. But when I first started off as a young financial professional, if you will, it wasn't like a whole lot of people willing to give the young 20-year-old like $1 million to invest. But what I did understand was real estate. I did understand banking. I did understand lending. So when I stumbled upon this, I was mind blown that more advisors weren't sharing this with their clients. So what a S block is, security based line of credit. If you have a non-retirement investment portfolio, and let me emphasize a non-retirement investment portfolio. So you got a stock portfolio, right? You got some Amazon stock, Apple stock, whatever the case may be. Did you know that that brokerage dealer or whoever you're dealing with may offer security-based line of credit where they would give you a line of credit based upon the amount that you have in that brokerage account, right? So whether you have cash sitting in that brokerage account because you want to take advantage of the higher money market fund interest rates inside of it, or you have stocks or whatever the case may be, that lender may be willing to lend to you anywhere from 50 to 90% of the value of that. Why would somebody do that? Well, hey, you come across a deal, right? You're working with Jesse, you come across an amazing duplex or fourplex and you want to buy it. And you're like, man, but I need, 50,000 or 100,000 to get into this deal. And you look at your stock portfolio and be like, well, I got to sell that. Well, if you sell your stock portfolio, you're going to have tax implications. You're going to, saying that money, well, first of all, that money is no longer working for you. And you're possibly going to have tax implications. So would it be nice just to continue to let that money earn in your right hand pocket and then get the security based line of credit and use that to actually purchase? And a couple things about the S block: does not report to the credit bureaus, typically no origination fees, typically interest only payments, right? So you can have your cake and eat it too, if you will. Continue to let your money grow inside your portfolio and get a line of credit from that broker dealer or that investment firm to then go out and actually accelerate your wealth creation by being able to use those dollars to then go out and purchase, real estate and things of that nature.
This is the one that for us changed the game. So I did not realize that my brokerage account, so, I'm earning my 10% annual average, and I'm like so proud of myself. I had no idea that I could arbitrage this money and go and make more money. So this is the one that's really kind of been the key for me. Let's get into whole life. I do want to get into the calculator itself. So, do you want to show, was it Which policy was it you're going to pull up?
I'll be brief on it. I'll show the life insurance whole life. So many people have heard of maybe infinite banking or the concept of bank on yourself or becoming your own bank. But unfortunately, we hear a lot about it, but very few people know how to actually do it. Right. So this is by far our favorite of all of the double leverage strategies, and a couple reasons why. With the whole life piece, if properly structured, and most people don't know how to properly structure it, but if it's properly structured, for every dollar you put in, you should have available anywhere between 70 to 80% of that dollar as cash value. That cash value, when looked at by the insurance company, can be used as collateral to get a policy loan. So what I like about this is I can have my money earning a higher interest rate inside this policy than the bank is paying me, in addition to getting no other benefits like death benefits and long-term care and all these other riders, if you will. But for intents and purposes of this right here, if I saw a deal that I want to jump on, I could actually get a policy loan. That means that my money continues to grow uninterrupted inside the policy. I can get a policy loan and then use that policy loan and then go out and do a deal, right? Now, here's the deal with the policy loan. It is a unstructured payment, which means, with your HELOC, if you draw down on your HELOC, your money. On your mortgage, your money. Credit card, your money. If you don't make those payments, folks is reporting that to the credit bureaus, can get bad. With a non-structured policy loan, you're not even required to make a payment. Yes, it's accruing interest, but again, because this is a private loan, no origination fees, no closing costs. It's just between you and the insurance company. You can access this capital. And if you're not in a place from a debt service perspective to make the payments on it, you don't have to make the payments on it. And let's say you never made a payment on it, which I'm not suggesting, but let's say you never did, and that loan continue to accrue interest. What will happen is when you pass away, that loan would just be deducted off the death benefit. So I know that was a lot. Let me share my screen real quick just to make this a little bit more tangible or digestible, if you will. So let me share.
Barry's going to show us how easy this concept is, because you just heard us talk about, 4, 5, 6 account types. And you're like, what? Maybe your head spinning. You're like, that seems impossible. That's really hard. We're going to show like, how easy is this to actually implement?
Okay. You guys are seeing my screen now.
Yep.
I'm trying to make it as big as I can. Okay, great. This is my actual illustration for my account. I'm putting in $2,000 a month into this account. So that's the $24,000. My guaranteed cash value for year one is $19,901. That's what I'm guaranteed to have as cash value. Again, this is when we say properly structured. Most old school whole life accounts and stuff that people try to sell, they might not have a cash value to year like 6, 7, 8, 9, 10. Properly structured year one. This is monies that I now have available. Not only did I have that cash available, I gave my family another $877,000 in death benefit if something should happen to me. So this is the way this looks from an illustration. Here's my actual account. Ooh, stay logged in. Okay, great. Okay, so now let me share this screen. So I have logged into my account, right? So here you have here my death benefit coming in at $866. And with this account, I funded this 2 months. Okay. So that means I put in $4,000. That $4,000 I put in, I'm already sitting at a cash value of $31.75. And I can come into here anytime I wanted to and say, hey, I'm going to request a loan at 5.1% interest. I'm eligible right now to take out a loan of $3,100. Literally, all I would do is
5.1%. What I would do for 5% of anything right now.
Exactly. I'll start my loan. How much I want to take out? Hey, I want to take out. I'm still sharing my screen. Yes.
Yeah.
I want to take out $1,000. Boom. I want that to go direct deposit. Right. I'm gonna hit yes over here. Boom. I'm gonna put in, boom. What I'm not gonna put in is my routing number and account number. You guys get the gist of it.
Put that in. Just put that in too.
You guys get the gist of it, right? And just like that, you have access to the money. So now we have this bank, and we have about 6 different insurance policies that we're running that play on, right?
Yeah.
So now I'm building my own bank. Instead of letting my $2,000 a month sit at the bank earning less than 1%, it is now sitting inside my account, earning much better than less than 1%. And now I'm becoming my own bank.
Love it. Y'all, let us know in the comments which of these accounts you have. Let us know, is this like blowing your mind? Because this is how the rich get richer. Period. Yeah. Flat out. These are the secrets that people don't want you to know. So we want to hear from you. Let us know your questions. Let us know anything in the comments, because we want to help you, right? So let's actually hop into the calculator itself. So I'll zoom out. This is what we call the double leverage calculator. And essentially it's going to show, if you were to have a holding account, which we went over a bunch of different examples, and you use that money to go out and buy real estate, what sort of long-term projections could you assume, right? And so we'll go through an example together. Leo says he's interested in the life insurance account for sure. Definitely. So first, you guys can get a copy of this at the end. We'll let you know how. You will need to fill in the cells that are only in gray once you have your own version. Use the account ranges or ask your custodian of that account for your exact numbers. And then at the bottom, you input the number of years that you want to analyze this period over, and then it will do some math for you. So we're going to go through an example. So let's say let's use SBLOC, because that's the one we're using. So Perry, I'm going to ask you some questions as we go. Let's say that my SBLOC has $100,000 in the principal balance.
Okay.
How much would that be growing at? Because it's in a S&P 500.
Okay, cool. So we pull up S&P 500, right? And I said, hey, what has been the average return on the S&P? It's gonna kick a number out at me. It's probably gonna be 9-10% return.
Yep.
On S&P 500, and I'm gonna say for the past 50 years. So I just typed that into Google real quick. It kicked out to me this number that said, hey, Since 1957, the benchmark index has delivered an average annual return of 10%. Well, there you go.
10%. Okay,
Yep.
nice, safe number. So that money, my 100K, is growing at 10% year over year, compounded annually, right? The loan to value on an S block, we're going to come back to our account ranges. We're looking here. So 50 to 90%. My personal account is 70%. So you good to use that? 70%. So that means that of my $100,000, I can borrow $70,000 of that money. Okay. I want to zoom in a little bit, but not that much.
Oh, much better. That's good.
Is this better? Okay. Okay, cool. And then how much is it going to cost me in interest for any money that I have pulled out of my line of credit, my S block?
Yep. So depends on the firm. I know ours kind of depends on the size of the loan, but let's say anywhere between, you kind of have already listed in there, right?
We're 7.5 right now.
There you go. Yep.
Okay,
So I was gonna say between 6 and 8.
Okay, perfect. So yeah, we're 7.5. I think it's 7.1, but we'll just do 7.5%. So, you know, I can borrow up to 70K, but it's going to cost me some money to borrow that. So I'm arbitraging here. 10%, my money in my brokerage account is growing at 10%, but it costs me 7.5% to borrow against it. So I'm arbitraging 2.5%, which is the difference there. I have seen other folks with easy 5, 6, 8 point spreads on arbitrage. So that's the first section. That's all you got to input. You only need to know 4 numbers. Okay. Now we're going to go down to the real estate section. And these are all descriptions. It's going to, you know, tell you exactly what to do. So let's say that our down payment, and let's say you're running the BRRRR method, and when all is said and done, you do end up leaving a little bit of money in the deal because we're in a competitive market. You want to make sure you get some deals. So you may leave a little money in there. Not every deal will be the perfect BRRRR. So say you leave about 10% left in a deal. So that's 10% down payment. Okay. That tells me that my $70,000 in my S block will let me buy up to $700,000 worth of real estate.
Woo.
Pretty good. Pretty cool, right?
Woo.
And that real estate is going to appreciate year over year. And so I am going to very conservatively put in a 5% year over year. Now, in Columbus, Ohio, we have seen definitely higher than that, particularly the last 5 years. But we want to look at a kind of a long-term projection. So we're looking at a 5% year over year appreciation on the real estate itself. And then if you are familiar with the 1% rule, it basically says that for every, like if you own a property that is worth $100,000 or that you're all in for $100,000, that the rent should be 1% every month. So 100K should bring in $1,000 a month if it meets the 1% rule. Now, we don't go out and buy real estate based on the 1% rule. Absolutely not. That's going to get you in trouble. You underwrite for real, but it just gives you a quick little indication of like, could this be a deal? So I'm going to say, let's say we are buying at the 1% rule. If you're buying in maybe a little bit riskier market, maybe you can get 1.5%, which is going to get you a higher rent, but you're trading it off. You know, typically the higher you go, the more risky the neighborhoods are.
It's like the stock market. The more risk you're willing to take, higher return, but you might have some headaches with that as well.
Yes, nailed it. Exactly right. You know, and there's other folks who are like, hey, I'm fine at 0.75%. So you can put your number in here. You know, if you're only seeing 0.75%, then you are going to be earning less money, right? Because it's a smaller percentage of the total. So let's say that you're buying at the 1% rule. This is going to say that you have a $7,000 monthly revenue, $84,000 annual revenue on this new real estate that you went out and bought with your S block money. Okay. So you're making 84K. Of course, you're going to have mortgages and all that. This is saying, you know, assuming that you bought $700,000 worth of real estate at 10% down, how much is financed? So you're still going to have a loan for $630,000. You're going to have interest on those loans, right? You're not just, it's not free money. So you're going to borrow $630,000. And right now we're seeing, I just got a 6.5 DSCR.
That's amazing.
It's really good.
I need to talk to you about that one.
I know. I'll definitely share. So, but let's run this at 7 and just see what happens. So if I'm paying 7% interest on that mortgage, and then the target profits after all is said and done is that we're always aiming for 20%. Okay. So 20% profit of your 84% annual, you're coming out $17K a year in money and profit. This is profit, money that you did not have. You created this money by buying real estate. Okay. So those are your inputs. There's only 1, 2, 3, 4, 5 numbers you need to know in this section. So you don't have to know a whole lot here. And let's look at a period of time. How many years do you want to analyze?
I like 10.
I like 10.
I like 10.
My plan is at the minimum, hold everything 10 years.
Cool.
Minimum.
I like that.
Okay. So look, if you own this for 10 years, not your original account is still growing. It's still growing. So in that 10 years, you created $160,000 by not touching that original balance. I know. You created $440,000. And this is only portfolio growth. This is not your original, the money you put in. So this is just the growth. You have rental profit that's $17K over the next 10 years is $170K. But it's going to cost you. You have some cost in order to go out and borrow that money. So $52K, your net worth by implementing this strategy in 10 years, which is the blink of an eye, has increased by $715,000. And if you had only kept your money in that original account, you still would have made 160. Hey, that's not anything to bat an eye at. But it's quite different than taking that money and putting it into real estate.
I got to say something. This is so powerful. It's not like it's my first time seeing this. We actually teach on this piece, but it's really cool to see it in a calculator, right? Because, and I just want to make sure that everybody is clear on this. When it says the total holding account growth, that is the growth, right? So your balance is 259, just to make sure everybody is clear.
Right.
It's not 100 to 159. That is your growth. So that 100,000 has now turned to 259, right? And that's not including the real estate. So you're already going to do well just with your brokerage account, but now you were able to accelerate your net worth increase, right? By now still making money. We call it making money in your left-hand pocket and your right-hand pocket. And while using somebody else's money. What's so powerful about this scenario, you still haven't used any of your money yet. Right, your brokerage account is still growing, and the brokerage firm gave you the line of credit, and then you use that for the down payment to then go to the mortgage company and say, hey, I need you to finance the rest of this. So you still haven't used any of your money yet.
It's wild.
Right. And the other piece I'll add to it here, if I'll take the liberty to do this, if you go back up, Jesse, you kind of had that area like, hey, you know what I'm saying? You're shooting for that right there, that rental profit, annual profit of 16.8. And I've talked to some real estate investors who I don't think they get the whole picture. They're like, 16.8, that comes out to being like $1,400 a month. Oh, you can't become blah, blah, blah. But here's the deal.
Yes,
that's the cash flow. Right? That's the free cash flow. We haven't even taken into consideration the tax savings that goes along with that, the tax shelter, right? The accelerated depreciation. We ain't even got into that. So if we looked at it holistically about this play, and you got an asset that's appreciating. Oh my goodness, like anyway, don't get me going.
No, you're good. So that is, that there's an assumption here as well. So it assumes you don't refinance, increase rent, or your expenses for the life of the property. You're going to increase rent. So your rent today and your rent in 10 years is not going to be the same number. So there's going to be some additional growth there. Yep. It assumes that you buy all the real estate in the year that you borrowed against the reserve. So in this scenario, if you buy 2 properties one year and 2 properties the next year and 2 the next year, it won't quite play out like this because you're going to lose some of that snowball compounding effect, but it's going to be way better than if you just kept it in your original account. And then it also does not factor in tax advantages, which Perry brought up. Yeah. So,
Sheesh.
yeah. So let's look. Okay. This is a 10-year projection. And I failed to mention down here that your original capital was 100K. That, again, you didn't even touch. That is a 13,000% return on equity. Return on investment. I don't even know how you can find that anywhere else.
If you got lucky on crypto, maybe
honestly,
you'll say, but that's amazing. Yep.
Let's look at 15 years real quick. So you hold on another 5 years. And again, compounding is the eighth wonder of the world. The longer you hold, the better you do, period, flat out, across any investment strategy. Mm-hmm. So this is, again, just the growth. 5 more years, you're up to 317. Your real estate has continued to go up. You're at $1.2 million. And just say this is truly your retirement plan.
Yeah. Woo!
$4 million. And all you did was buy a couple houses 10 years or 30 years ago.
Yeah. That's major.
Okay. Perry, y'all, if you want this calculator, we're giving it out. We're giving it out totally free. Just let us know in the comments. If you're on the replay, if you're on YouTube, wherever you are, let us know in the comments and we will get you a copy of this. Just let us know calculator, comment calculator, and we'll get it over to you. But let's kind of wrap this thing up. So I hope that y'all see the power of what's going on here and the power that it's the knowledge, it's the guidance. It is the step-by-step, because Perry didn't know half of this. I taught him. I didn't know half of this. Perry taught me. And the power of it together, y'all, it's good.
It's explosive.
Yeah.
Yep. It's totally explosive. So I know some people are like, man, this is amazing. What Jesse is showing here is something that we internally inside our firm called 4D banking, where you have all of these different assets that you can actually use as collateral or use to bank off of, so that you can go out and accelerate your financial, your path to financial freedom. So something that we do is we do actually a 5-day financial freedom boot camp where we go through this. But it's not just about going through the numbers. It's really about adjusting the mindset. You have to have this paradigm shift. We have been conditioned to believe that debt is bad. Oh, I don't want to take on debt and things of that nature. Yet, while we look at how the banks make their money and how the wealthy make their money, they are okay with leverage. They're okay with having what we call a producing liability, a liability that, may be a liability, but that liability shows up on both sides of the balance sheet. That liability actually got me an asset worth this over here that's appreciating and giving me cash flow and tax advantages, right?
Don't they say that whole life policy, like the biggest owner in the world is banks?
Oh, absolutely. If you guys Google, BOLI, right? bank-owned life insurance, Wells Fargo has 18 billion in this scenario. Yeah. And the reason, guess what? They're buying real estate, they're buying businesses, they're working on expansion. So this whole think like the bank piece is huge. So anyway, long story short, I'm going to give you guys a website to go to. This is our website. It's called thinklikethebank.com. Thinklikethebank.com. On there, it's going to have some of our resources, but also to, just kind of get you plugged away. And then Jesse will have a link for you guys if you're interested in our boot camp. Definitely jump in. Our next one is March 10th. So we're about a month out.
Yeah.
Go ahead and reserve a spot now. It will be transformational.
Yeah.
Not just learning, but also to being able to unlearn some things that have been keeping us from creating financial freedom.
Yep. 100%. I recommend. I have personally been through the level above the boot camp, but the boot camp, y'all, is fantastic. 5 days with Perry. You can't get a better value. And I know Lizzie on my team went through it and it changed her life in a lot of ways. So highly recommend. And then if y'all wanted to learn more about the real estate piece, I actually have 2 things I want to offer you. First, we have a little mini course. It's totally free and it teaches you my exact method, how we're buying with 10% down or less than 10% down, how we are renovating the property up to a nice standard that's going to give you longevity. It's not going to have you with these maintenance headaches. So, finding the best renters who are going to take care of your assets. I have a mini course that goes over all of this. So just let us know, mini course in the comments. We'll send you over the calculator. We'll send you that over. We'll give you Perry's bootcamp. And then I have a workshop directly after this. If anyone's interested, Lizzie's going to drop the link in the comments, and we're going to go over that method. And it's awesome as well. So some more FaceTime. So yeah, Perry, thank you. I can't thank you enough. You're such a valuable asset to our community, both the free big group and also our paid students. So really couldn't do it without you.
Oh, no, I appreciate you. You have been a blessing to our family in more ways than you realize. And like I said, I'll be touching base with you because we got this land in contract and we don't know what to do. We just buying the land. We need help.
Oh, yeah, no, okay, let's talk. Awesome. Well, I appreciate it, and we'll see you next time.
All right, y'all. Peace.
Yeah.